Hi, Sebastian here from Wealth Depot. Just wanted to give you all a quick update of all things superannuation and the recent alterations and updates to the government stimulus packages. I thought with 1 July kicking over would be the great time to review certain strategies and ideas. That way, to provide best possible assessment and review of how you can position ourselves over the next 12 months. So as always, general disclaimer here, should you require any sort of more personal advice or how to ensure that any of these changes or strategies may impact on your actual financial situation, it's important that you always give us a call, come in, have a meeting, and for us to provide that advice in a proper, considered manner. So yeah, there's been a number of measures that have been announced to support the Australian economy in response to the coronavirus. So we put together a summary of the key measures and the updates that have come through. I also did want to focus a little bit on superannuation and how those that maybe have taken an early release of their super, or those that just want to make sure that super is working as effectively as possible for them, some of the strategies that we can implement to ensure that your retirement savings will be there and will support an income on the eventual retirement and loss of the ongoing or sort of personal exertion income. So I'll start here with super. So recently there was an extension to the early release of super application period, now to the 31st of December. So those of you that were maybe considering it or looking at the circumstance leading into this quarter, have a little bit more time to make a more considered assessment of if that money will definitely help you to support and top up your income to obviously help you to maintain necessary living expenses, mortgage repayments, education fees for kids, and so forth, to ensure that your family and yourself are able to maintain your lifestyle. Obviously, drawing down on your super does have implications. There's been obviously a lot of media around that, around whether it's a good thing or a bad thing, how it's going to detriment your retirement savings in the future, and it's an assessment that is personal and that needs to be considered on an individual basis. So some of the things that in terms of some ideas about how to grow your super over time, will also be maybe a little bit pertinent for those who have taken their super a little bit early, due to the recent pandemic to bolster their family and personal cash flow. Just be aware that the actual extension hasn't been legislated just yet, but there should be bipartisan support for it. However, Labor government is a little bit sitting on the fence on this one, so there might be some back and forwards regarding whether it actually gets up or not. So just keep an eye on it, and obviously, no doubt, we'll provide further updates in the near future. But so just if you definitely are considering it, just be aware that 24th of September is the current closing date for the applications. Some of the other super measures that were previously announced, this is more in regards to our self-managed super fund clients here, that the previous proposal to increase the maximum SMSF membership limit from 4 members to 6 members, the commencement date will be after the royal assent. It was expected to commence on 1 July, but that's now being pushed back a little bit. Start of the retirement income covenant will be deferred to 1 July 2022. This was all about I guess a complete overhaul and overview of how retirement income is managed within the superannuation system, to provide more certainty for members on retirement, to ensure that they actually did have some means and better understanding about how to actually establish an income stream and what that income stream would look like, and that it would potentially even last your lifetime. So there's a lot of work in this space at the moment, and further developments obviously are due, but that's been now sort of somewhat deferred until 2022. Amendments to the Treasury Laws Amendment Bill, which basically was all about ceasing operational eligible rollover funds. So this had to do with certain loss accounts or inactive accounts. So very minor stuff, but things that were going to be tidied up and to provide, again, a bit more efficiencies around the whole superannuation system. So get back to sort of the real focus of today's session that I wanted to cover was rebuilding super after early release, or whether it be early release or just being aware of the strategies available to build your super and retirement savings. And in particular, a bit of a focus on how to rebuild if you've taken an early release. And also that's going to depend on a few variables in terms of how much you did actually withdraw, your age and years until retirement, your investment allocation and future returns, fees and other accounts expenses, and obviously contributions. So, but there are a number of obviously contribution strategies available, and therefore thus they can all help everyone that's in a space or wanting to grow their super. So it's not just limited to those who've actually taken an early release or so forth. So the sort of top 6 sort of strategies that we've sort of identified are salary sacrifice, pre-tax salary, looking at your entitlement to receive a government co-contribution, make or receive spouse contributions, make or catch up concessional contributions, and make personal contributions and claim a tax deduction. So these are some of the contribution strategies that are available and always have been available. There's been some tweaks of late, some extensions of eligibility and how those who maybe are over 65 can still make these contributions around the work test and so forth. But essentially, if you're not aware, touch base with us. Let us know what's going on, and that way we can help you, make the right type of contribution or the most tax effective contribution that's going to provide you hopefully a better outcome and based on a smarter decision. Some of the quick things that did come through recently that were passed was the measures to extend those that are 65 to make voluntary contributions without having to meet the work test. So this work test used to sort of get in the way of what contributions you're eligible to make, and basically we're just aligning this now to the pension age of 67. So, but just be aware that the bring forward trigger rules they aren't currently available for those 65. It is proposed to commence, but again, it's not legislated, so we have to just be careful that we're not triggering those contributions just yet. But we can definitely rely on not having to meet the work test if you're aged 65 and 66 going forward. So that'll help us, to provide opportunities for clients to make, non-concessional contributions, make concessional contributions, including catch-up contributions. The ability to implement a recontribution strategy, and that's more about estate planning and getting those sort of tax components better positioned for that future event. Potentially to manage tax, including capital gains tax. The whole thing about realising assets, but also tying that in with some tax planning and also retirement saving development building can have a great outcome. Spouse contribution tax offset or co-contributions allows us to extend that a little bit longer. Make contributions on the small business CGT concessions. So valuable piece of legislation there for those that are self-employed or and meet those very very tight eligibility rules, which does take a little bit more effort to understand and to implement correctly. And also transfer of foreign super into Australian super accounts. There's also the ability to if you have potential pension accounts in the UK, for example, to look at bringing them over to the Australian super system. To again, look at those advantages, pros and cons, and risks about, do you keep the money over there and then also draw down a pension when time comes, or do you move that money to Australia under our superannuation system? With spouse contributions, just be aware that they have extended the age now to 74. So currently we're only to age 70, so they have extended it out. And I think that's just in keeping with, building a sustainable and viable system that's going to provide opportunity and flexibility for those that are maybe still working post 65, and to help build spouse member benefits up. And that can come to play with certain other strategies around could be age pension or seniors healthcare card or whatnot. So there's all these other things going on, including even aged care planning around how we best position partners' superannuation accounts and how they're going to be accessible in identifying certain eligibilities. Just a quick note on the income stream drawdown rates. As most of you should be aware that those that are on account-based pension or transitional retirement income pensions, the minimum drawdown rates have been reduced for this financial year as well by 50%. So, for example, if you're under age 65, drawing on a TRIS, a transitional retirement income stream, or an account-based pension if you're retired, your normal minimum would be 4%, but now for this financial year it will be 2%. And that's where we can also, that provides also, again, some more planning and strategies around, do we continue to draw down your pension accounts, or do we look at topping up through your accumulation accounts instead? That way to keep your transfer balance cap, the 1.6 million number, in our mind, to make sure that, from a tax structure, we're doing the best we can, so forth. The other one is also about deeming rates. These also were reduced to provide further assistance to those on age pensions and those in aged care as well, around the means tested fees. So just be aware that they have been reduced. So where we're sort of contemplating, do we stay on the old capital deductibility method of calculating your income under the for aged care pension, or do we switch over to redeeming rules? Something to consider going forward. And just a little note there that if your financial assets for a single are under $252,800, then you may likely be receiving the full age pension, and then so forth with the couple. So that's there could be super, cash at bank, other sort of financial product accounts where you're not maybe assessed on the actual income received, but you're assessed on the deemed income. So something to be aware of. JobSeeker, the supplement, the coronavirus supplement, was scheduled to end on the 25th of September. They are extending that to the 31st of December. However, there are going to be some other conjunction changes. So increasing the income tax-free area for the income test and adjusting the income test taper rates, amending the partner income test, reintroducing mutual job obligations, reintroducing the asset test and liquid assets waiting period. So that's a big one, because previously it didn't matter how much assets you held, you were still going to be entitled to the job seeker, and also your how much cash you had at bank will also depend on when your entitlement would actually commence. So they're reintroducing those measures again, so that's going to maybe impact a few people, and reducing the amount of corona supplement payable overall. There's going to be some continue to reduce eligibility criteria for sole traders and individuals who have been stood down or have lost their job, and casual workers subject to the income and assets test. So some of those are initial means testing and whatnot will still be on foot, but there has been some changes to the biggest ones regarding the income-free area and taper rates. So from September 20th of September to 31st of December, income-free area will increase from $160 per fortnight to $300 per fortnight. So this means that a person is able to receive $300 per fortnight income before their entitlement to job seeker is reduced under the income test. So that's a big thing, and that's going to provide some clarity and certainty for a lot of people. And then after that, the income after you receive more than $300 per fortnight income, your actual entitlement will reduce by 60 cents for each dollar. So just be aware of those things. Whereas the current arrangement was that the payment would be reduced by 50 cents for each dollar earned between $106 and $256 per fortnight, and 60 cents in the dollar for any income above 256. So they've increased that sort of threshold there, that taper rate a little bit for those that are probably just going to be on that cusp of obviously finding work, earning income, steady income, but still needing that extra bit of top up and support. Additional changes to the partner income test. So from 25th of September, the recipient's partner will be able to earn up to $3,086 per fortnight, or roughly $80,000 a year, before entitlement JobSeeker reduces to nil. So, and then the taper rate will increase to 27 cents from 25 cents for each dollar of partner income that exceeds $300 per fortnight. So, although the partner income will reduce entitlement at a slightly increased rate, they're offset by the increase in the income test threshold to $300 per fortnight. The effect is that no JobKeeper recipient will have a reduced entitlement as a result of this change. So the government's trying to do the best they're keen here to ensure that no one's going to be worse off, but in saying that, to try and ensure that the system is still viable and sustainable, and to provide them even more flexibility should the need require that people be on the JobSeeker payments a little bit longer. So current asset tests for those that are going to be applying for the JobSeeker, and obviously still and on the JobSeeker, that from 25th of September the asset test will be reinstated. So this could have a pretty big impact on those that are asset rich but income poor. So they'd be aware of those thresholds there for homeowners and non-homeowners, singles or assessor singles or couples. That those asset tests will be reinstated, and also the liquid asset waiting period will be reinstated as of 31st of December. So that's where we're looking at your cash position and knowing, okay, well, because of your savings and your buffers that you've diligently put away, that access to the income supports like JobSeeker will be extended. So just be aware of those things. And reintroducing the mutual obligation requirements, which were temporarily suspended until 8th of June. Since then, the mutual obligation requirements have been gradually introduced, and this gradual introduction of requirements will continue. So just be aware of those things as well. And then finally, the coronavirus supplement has been extended to the 31st of December. So it's paid to eligible recipients at a rate of $500 per fortnight, but it will reduce to $250 per fortnight from the reporting period commencing 25th of September. So just be aware of that. Even though it's going to be extended all the way through to December, it will reduce from 25th of September. And the supplement is paid to both new and existing recipients of eligible payments, so just be aware of that. And those that are on part payment or a full payment or full entitlement under the JobSeeker payment, youth allowance, parenting payment, Off-study, ab-study, farmhouse allowance, and special benefits. So how does JobSeeker and JobSeeker, continue to coexist? Current arrangements are in place on the 25th of September. Most people shouldn't be receiving both payments because the JobKeeper payments are a reportable income for Social Security purposes. Thus, but the reduced rates of JobKeeper from 25th of September, many individuals are then eligible in receipt of both payments due to those income tests. So just be aware of that previously, because you might have been on JobKeeper, you may have been entitled to JobSeeker, but maybe because of these taper rates and whatnot, that you may have been entitled to both to ensure that your overall income is at a minimal level to sustain your living and cost of maintaining your family needs and your own personal needs. So just be aware of those things, that there might be a period now where an overlap or where you may be entitled to both will be available. So JobKeeper 2.0. From 28th of September, the JobKeeper payment will reduce and payment tiers will be introduced, and an ongoing test for businesses will be used to determine eligibility. So a few things going on there. So the current flat rate of $1,500 per fortnight will end on the 27th of September, and even though the extension of JobKeeper will be has been approved to the 28th of March 2021, there will be now two new rates. So between 28th of September and 3rd of January, JobKeeper will be $1,200 per fortnight for those working for 20 hours or more per week, or reduced to $750 per fortnight for those working less than 20 hours per week. And then from 4th of January to the 28th of March, be reduced to $1,000 per fortnight for those working 20 hours per week, or $650 per night per fortnight for those working less than 20 hours per week. So there's definitely information around this stuff available. Also, you can touch base with us here at Wealth Depot. I know our good friends Michelle and Romano are doing their best to keep their business clients aware of the changes to ensure that they're meeting their requirements and reporting obligations. And the big one about those who actually are claiming the JobKeeper is that the necessity to support your eligibility will kick in as of 28th of September. Whereas if you basically were eligible for a period of time previously, then you're on JobKeeper until the 20th of September, indefinite type of thing. But that's going to be changing soon as well. That's really about it for this quick summary today. A lot to take in. I've tried to run through it as fast as possible, but we've got information available via our social media pages, YouTube channel, website, but also the best thing to do is pick up the phone, give us a call, send an email, and we'll be happy to respond and provide some guidance around any concerns you may have or clarity that you might need. And but we look forward to talking to you guys soon. And take care, stay safe, and take care. Bye bye.